D. Major currencies affected by rates. Central banks' overnight interest rates, economic data, and politics are the main fundamentals that affect currency pairs. Interest rates. It is the responsibility of central banks to maintain monetary and financial stability. Through interest rate manipulation, they accomplish this. Increasing an overnight interest rate by a central bank increases demand for that currency because investors and traders seek a higher yield, which causes its exchange rate to appreciate. Economic data. Economic releases provide traders with an insight into the health of a nation's economy. Currency rates are influenced by a variety of economic data, including the Consumer Price Index (CPI), non-farm payrolls employment data, gross domestic product (GDP), retail sales, and the Purchasing Managers Index (PMI). Politics. The forex market is more volatile during times of trade wars, elections, corruption scandals, and policy changes. A currency's relative value can be boosted or depreciated by the government by affecting the economy. Volatility. Smaller positions are usually taken with more volatile currencies, while larger positions are taken with less volatile currencies. A sudden change in interest rates, a drastic change in the economic outlook, or political instability can trigger volatility in any of these pairs.